Hello, I'm Hunsley from Livewire Markets, and welcome to Signal or Noise. Well, 2.5 years after the first rate hike, the US Federal Reserve cut interest rates by 50 basis points recently. And while the Fed was not the first major central bank to start cutting rates this cycle, this jumbo cut is the one that sends the most ripple effects across the world, including here in Australia. But what happens from here? After all, investors spend so much time debating the timing of the first cut that it's probably become easy to lose track of what happens beyond it. Well, joining me are three investors who have some ideas and opinions on the matter. As you might expect, our resident economist, Deanna Messina of AMP, is one of them. And joining the two of us this month, Cameron McCormack, Portfolio Manager at Van Eck, and Sally Old, Chief Investment Officer at JB Weir. Hello everyone, thank you for joining me. Cameron and Sally especially, welcome first time.
Thank you, Hans.
Thank you.
Well, let's just get straight to it. I've heard it said, and maybe you all have heard it said as well, that the first cut is the deepest. Well, if that's the case, then markets reacted pretty strongly to this 50 basis point cut, which seemed to be pretty line ball right up to the actual decision. But for investors, do you think that the first rate cut provides a signal to make investment decisions, or is it noise because if you hadn't moved your money before the rate cut, you've missed the opportunity? Deanna, signal or noise?
It's a signal that we are going to get this ongoing easing in interest rates, even though it was already priced in by markets, that there was already a very high chance of a 50 basis point priced in, and financial market pricing hasn't really changed since the Fed, but it did give equities a boost the day after the decision. And at the current point in the cycle where the recession risks are still high, September is usually seasonally very weak, we've got a lot of geopolitical noise, it does seem to have given shares this bump up that they otherwise may not have had if the Fed didn't cut.
Yeah, and a welcome one, I guess, if you're long the market. Deanna, speaking of equities, let's bring up your chart now. This is a chart I suspect a few of you might have seen in your time, but in case you haven't, this is the S&P 500's performance following rate cuts. Why is this chart important to you?
Well, it's sort of a good, I guess, reminder to step back and look at what the longer term trajectory usually is for equities after the Fed cuts. A lot of people say that bond yields tend to decline in that cutting cycle. So we looked at what happens to equities, and what I took from it was basically in a year's time, equities are generally higher after the Fed starts cutting, but it does depend on whether you get a recession or not. The periods that are associated with a recession see the worst equity markets performance, as you would expect, because shares usually fall by between 20 or 30% in recessions, and the periods that have the highest returns are usually associated with no recession. So I suppose the key takeaway is, we may get some downside to shares the next few months, given some of the things that I mentioned before around geopolitical risks and the November election in the US and the poor seasonality, given that shares have had such a good run as well up to the year to date. But in a year's time, we should still see positive performance from shares.
Yeah, that's why taking the long view is important. Thanks, Dee. Cameron, do you know? Signal or noise?
For me, it's noise, and I think it's a really interesting observation. And I think in terms of what we've seen in the markets of late, I think they've really taken that observation in I guess, the market's really anticipating a soft landing. Looking historically, generally speaking, the majority of soft landings have seen strong equity performance post a rate cut, and that's certainly, been a key driver of markets of late. Having said that, I think that if you look at where valuations are at, particularly in the large caps, they're looking, somewhat more stretched, and certainly that's been a big play.
Yeah, no, absolutely. Sally, do you know? What do you think? Signal or noise?
Signal. I think the Fed made it really clear that the economy needs a less restrictive policy stance. And so the Fed chair talked a lot about recalibrating policies. So basically taking the argument that if you think risks are broadly balanced to inflation in the labour market, then you need a policy setting that's closer to neutral than very restrictive. And I think, whether we look in nominal terms or in real terms, absolute or relative, a cash rate in the US of 5.25 to 5.5 is genuinely restrictive policy. And so I think the argument for the Fed was, you need to be quite a lot lower quite quickly, so let's not muck around and just get it done. So there was definitely a signal in that. But I think it was also interesting that at the press conference, the Fed chair was probably more balanced and open-minded than maybe the market was expecting. And he made it really clear that the pace of the easing cycle is going to be dictated by the data. And it's possible that the labour market holds in better, that inflation maybe isn't as well behaved as they would like. and they have to sort of slow the pace at which they take some of that restrictiveness out. Or it could just be that things happen a lot faster and they can continue to cut quite aggressively. So I think the Fed is reasonably open-minded as to where to from here, but it's an interesting juncture in markets because, as Cameron said, markets basically pricing in the soft landing. So the set of forecasts the Fed gave us, at the end of 2025, inflation's almost 2%, growth is 2%, a bit above trend, and the unemployment rate is only 20 bips higher than where it is today. I mean, that's a sort of Goldilocks outcome, and the market's, I think, taken that hook, line and sinker. But the bond market is pricing in something different, and bonds are saying, the front end of the yield curve is saying the Fed's got at least another 200 basis points to deliver over the next year and a bit. And I suspect if that's what they're delivering, then it's probably because things aren't quite okay in the economy. And so there's a little bit of a dissonance between what equities are thinking and what bonds are thinking. I'm not sure they can both be right.
No, yeah, and then we'll find out which one's the smarter money this time. I want to pick up, Sally, on what you were just saying there for our second topic. And now we've already seen 150 basis point rate cut from the Fed, and even though Chair Jerome Powell specifically said that investors should not expect this to be the new normal pace, we know A, that markets always want more, and B, central banks don't always get what they want, provided it doesn't lead to a recession, of course. So I'd like the panel to share with us one data point, and Sally, I'm going to start with you for this round. Given the 150 basis point rate cut is already in the bag, what do you think is one data point, and the level if you want to stick your neck out to, what is one data point and level that would signal the Fed to start making larger cuts at future meetings, turning that 50 basis point first move into something more regular?
Sure. So I think the labour market is basically super critical to all of this. And we have seen over the past couple of months an evolution in the way that the Fed chair has spoken about the labour market. So he said that, it's closer to balance, it's in balance, and now we're at the point where they're saying it's actually maybe started to swing the other way, and they want to do everything they can do to support the labour market. So it resonates a little bit with what our own central bank talks about, which is trying to preserve some of those job gains in the labour market. So if there's one thing that's really going to pressure the Fed to deliver a subsequent 50 basis point rate cut to the one that we just got last week, it's going to be, I think, the unemployment rate moving higher than they anticipate. Because like we were chatting about before, they've only got a 20 basis point rise in between now and the end of the year. And so they're sort of punting, I think, that they can do enough quickly enough to cap out the unemployment rate. And so if it starts to move a bit more quickly than they would like, then they will respond to that pretty aggressively.
Small margin for error if you only got 0.2% to play with. Sally, let me stay with you and we'll take a look at your chart that you brought along. We've got the S&P 500 versus the unemployment rate. Explain to us what we're looking at here and why it should matter to investors.
Yeah, sure. So what we're looking at here is just year-on-year returns in the S&P 500. On the left-hand side, that's the dark blue line. And then what we're looking at on the light blue line is basically the 12-month change in the unemployment rate. And we've turned it upside down so the two series marry up pretty nicely. But basically, when that light blue line heads down, that represents an unemployment rate that's going up. And so at the moment, you can see those two things have tracked each other pretty well for a couple of decades. And at the moment, there's a bit of a divergence. So equities are sort of telling you a story that everything is going to be okay. The labour market's saying, well, if historical relationships are any guide, maybe equities are looking a little bit optimistic relative to fundamentals in the real economy. And so a bit like bonds and equities, only one of those series is going to be right. And this is why the labour market, I think, is so critical from here. You
brought this up a couple of times now, that kind of like that distance between bonds and equities. Who do you think is going to be right?
It's a good question. I mean, I think historically, bonds have tended to be more right than equity markets. But having said that, we are at the mercy of the data, and we know that data doesn't always go in one direction, and it can be quite hard, I think, as an economist or a strategist, to try and discern between a soft landing and the early months of a recession. They often look quite similar, and so this is why I think the Fed has been really clear about saying, look, we are really data dependent at the moment, and what we do and how quickly we do it is going to depend on what we see in the actual data. So.
Yeah, no, absolutely. Thank you, Sally. Deanna, to you now. What is one data point and the level that might signal the Fed to make larger cuts at future meetings?
I completely agree with Sally that it's around the labour market. So the level of non-farm payrolls growth, if the pace of employment demand non-farm payrolls is growing by less than 100,000 a month, and the unemployment rate goes above 4.5%. The SARM rule indicator, which is basically the change in the unemployment rate relative to its 12-month low, which is historically always lined up with a recession. It's never given a false signal. You can also take that on a state-by-state basis to look at which states have had this increase in the unemployment rate. That hasn't always been as good of a signal, but I still think it's important. And then in that broader suite of labour market indicators, the initial and continuing jobless claims, which can bounce around a bit. We've seen some sort of spikes matched by the following week where they've come back down. So a few distortions going on in the data. And then of course some of the surveys like the Conference Board around the number of jobs that are hard to get, easy to get. So the whole broad suite of labour market indicators is really important, but the key is the payrolls data. That is what the Fed is telling us that they're focusing on right now.
Yep, no, absolutely. Cameron, one data point and the level, sir, that would signal the Fed to make larger cuts at future meetings.
Yeah, I'd certainly agree with all the panelists. Certainly jobs data will be the key metric that I guess the Fed will be looking at very closely, watching it like a hawk. I think if we start to see, in particular, the unemployment rate, tick above that 4.5% range, that'll certainly create alarm bells. The Fed's, expecting, in their forecasts for unemployment to peak at 4.4%. So anything above that, you could start to see more, significant rate cuts come into play.
Yep. Well, Cameron, let's take a look at your chart. Now, funny all of us are referring to the labour market, but your chart actually has nothing to do with the labour market. It's the US ISM manufacturing PMI. For the benefit of our audience, what is this economic indicator and why should it matter to investors?
Yeah, so the ISM manufacturing PMI index, it tracks the change in production levels in the US economy. So while it's a key metric, well, it's a leading proxy for economic activity. And it also tells you, broadly speaking, the phase that the US economy is in. If you look at the chart, over the last 18 months, the, manufacturing activity has been in this contractionary environment where PMI has been below 50. So that's broadly meant that, the US economy has been in this late cycle environment. Now, hopefully, with the prospect of rate cuts, we should hopefully start to see manufacturing activity pick up, which would signal, a rotation potentially into more cyclical, asset classes.
Yeah, no, absolutely. All right, thank you, Cameron, for bringing that along. Speaking of asset classes, it's time to move to our open discussion. I'm really looking forward to this, actually. Before we all gathered here today, I asked each member of the panel to fill out an asset allocation matrix, and we asked each panelist to share with us their favourite asset class that they would be in on behalf of their investors should certain scenarios play out. And for your benefit, here are the three scenarios. The first scenario, the Fed has well and truly cut too late, they've blown it, a recession becomes inevitable, unemployment spikes, and 50 basis point cuts, 75 basis point cuts become the new norm. So that's the first scenario. Second scenario, the Fed has preempted inflation's fall, and instead of falling below 2%, it actually rebounds to above 4%, and the 25 basis point cuts look like they will be replaced by emergency hikes midway through a rate cutting cycle. So that's kind of like the closest thing we can have to a no landing, in case you've heard that in the press before. And finally, the last scenario, the one that the markets are priced for, the one everyone wants, it's nailed the cutting cycle, it's nailed the timing, you get a Goldilocks scenario. With that said, Cameron, we're going to start with you. Given those three scenarios, we've broken this down by asset class as well. Walk us through your table and just the rationale behind each of the decisions that you made.
Thanks, Hans. There's certainly, a lot to unpack. So starting with, a recession, in a classic environment, you'd expect your traditional sort of risk-off environment. In that scenario, you'd want to be defensively positioned and also be invested in select asset classes that are more, rate sensitive. So starting with stocks, we think that investing in quality companies makes sense. Typically what you see in periods of heightened market volatility and during periods of recession, you see investors see a flight to quality. So looking for companies that traditionally or have historically delivered more stable earnings growth. And what you find is that those companies have historically outperformed, say, in the global financial crisis, during the dot-com bubble, and also during the COVID-19 drawdown period. In terms of bonds, more generally speaking, certainly investing in long-dated government bonds, we think is the place to be, purely for the fact that, if you're expecting a recession, you'd expect interest rates to fall, and naturally being long duration would be the place to be. In terms of, I guess, why you wouldn't want to be necessarily in corporate bonds, where you'd expect credit spreads to widen, given that element coming through. In terms of alternatives, certainly gold, it's considered the safe haven asset, so that makes sense. And in terms of, I guess, cash positioning, you'd want to be more overweight, given the sort of uncertainty in terms of what's happening in the markets. But having said that, it gives you the opportunity to really, selectively start to, I guess, reinvest proceeds should sentiment start to improve. So that's the first scenario. Looking at, I guess, the Goldilocks scenario, in this scenario, you'd want to be, I guess, go up the risk curve in terms of your asset classes exposure. So looking at small caps, looking at private equity, for example. In terms of, I guess, if you saw this no landing scenario, we certainly think that a good parallel to reflect on is the experience during 2022. What we saw in 2022 is we saw value companies, for instance, outperform. And this was an environment where we saw rapid surge in inflation. Naturally, markets started to price in high interest rates. So anything sort of short duration did well in this environment. So naturally, value companies being floating rate in terms of bond exposure and so forth.
All right, perfect. Thank you for explaining that all to us. Sally, we're going to go to your table now, and if you could walk us through this and the rationale behind each of the decisions you've made.
Sure. So I think recession, we put down basically real assets in stocks, so infrastructure and REITs. And so, I think the message with recession is going to be that central banks have got ample room to cut. The Fed's starting from above 5, and so there's plenty of capacity. And so I think the market reaction in a recession scenario is going to be, it looks pretty horrible for a few days, and then the market's going to understand pretty quickly that central banks are there to cut. And I think things that are leveraged to low rates like infrastructure and REITs probably do okay. In fixed income, we put Aussie bonds basically because they're the one bond market that doesn't price in that much. But if there's a global recession, there's scope for them to really outperform. Alternatives, same as Cameron, gold, it tends to do well when rates fall because the opportunity cost of holding gold goes down. But also it's got proven history as something you can put in a portfolio that's resilient to drawdowns in equity markets. And as Cameron said, you want to hold a bit of cash because you want to be defensive and you want to have some dry powder to deploy when you think asset markets are on the turn. I think the emergency hike in a cutting cycle, to me, I'd sort of say that's the end of the cutting cycle and we're now in a tightening cycle if that's what we're doing. Yeah. So it's going to be a pretty quick reversal. And so, when rates are going up, can often be a bit bumpy for equity markets. You really want to gravitate to that quality part of the equity market, low leverage, management teams that can protect margins, that have got experience of managing through those tougher times as rates go up. Fixed income, not sure you want to hold very much of that. Alternatives, probably looking at commodities. Like if we're worried about inflation again, we want some inflation hedges or things that will move with inflation. Hold a bit of cash as well. And then in Goldilocks, small caps, same as Cameron. Fixed income, pretty happy to be in high yield bonds. Alternatives, we put in private credit just simply because of the returns on offer there. And cash, not sure that you need to hold too much in that environment. You should be fully invested in Goldilocks because there's a lot on offer. Yep.
Perfect. Sally, thank you very much. Deanna, bring us home. Walk us through your table, please.
So in that recession scenario, I suppose initially everything would go down quite significantly, particularly from an equities point of view, but you'd have to sort of see where the dust settles. And in the interim, we would favour some more of the US large cap stocks, especially around the tech sector. We think that the tech stocks are probably a bit more recession proof than some of the other US equities. So that would be our overweight. For fixed income, long dated government bonds, as the rest of the panelists said. Alternatives, we've said Bitcoin, but I would agree that it would be gold as well. Some of our portfolios have very small position to Bitcoin at the moment. And for cash, overweight would make sense in that environment. I sort of agree with Sally, the emergency hike and a cutting cycle seems really hard to get my head around. But I suppose when we think about what would be the driver for that, the way that I read it would be maybe there would be a large fiscal stimulus from China or some other sort of global exposure, like big increase in commodity price, a big increase in oil price. So in that environment, we thought it would be best to be allocated to wherever the potential source of upside is from. So if it's like a China stimulus, something that's more related to the Chinese economy, or a proxy for that would be Australia, LATAM even as well, or if it was a bit of a commodity shock, then maybe some of those gold miners. Fixed income, short-dated floating rate notes, which I think Cameron said as well. For alternatives, the unlisted infrastructure space would probably make sense in that environment, a bit of a hedge, and overweight to cash. And in the Goldilocks, which is basically what we're in right now, are priced for overweights to global equities, particularly to the US, and our portfolio management teams have said momentum stocks, which is basically ranking the best performing stocks over, say, a 12-month period and seeing where that momentum is and investing
with the
further
crowd,
into those.
essentially.
Yes, that's right. For fixed income, high yield credit, because of the low spreads there, alternatives, private equity, and underweight to cash.
And that, my friends, is Signal or Noise. A big thank you to a wonderful panel. To Cameron McCormack of Van Eck, thank you very much. Sally Old of JB Weir, come see us again, thank you. And of course to Deanna Messina of AMP, thank you very much. If you've enjoyed the program, you can subscribe to the Livewire Markets website, our YouTube channel, and our podcast. And we'll see you again soon for more Signal or Noise. Bye for now.